Good morning, everyone. This is Daily Trading Analysis with the weekly recap for this week, which it's a little bit confusing. Let me first start with the sentiment analysis of 35. This scoring is because of the economic data. We've seen core PCE increasing 0.2 and 2.7. That's a negative signal. Consumer spending and income, we've seen also negative signals on the negative, but we've seen also a dramatic geopolitical de-escalation and increasingly dovish commentary from the Federal Reserve, which should be providing a strong tailwind for equities. Let me explain you why. We first started knowing yesterday, Friday, with PCE price index showing a stubbornly hot inflation data, and the sudden eruption of a new trade dispute with our northern neighbor, Canada, which is creating significant headwinds and uncertainty. However, the development of the dramatic de-escalation in the Middle East conflict, it's been pretty good for the markets. After days of intense tension, which saw Israeli strikes on Iran and retaliatory missiles launches that put global markets on the edge, President Trump announced a US brokered ceasefire. This news single-handedly pulled the market back from the brink of a major risk-off event. The impact was immediate and most profoundly felt in the energy markets, where oil prices plummeted sharply as the immediate threat to supply and transport through critical choke points subsided. This development removed what was arguably the single biggest geopolitical risk hanging over the market, providing a massive dose of relief and a strong foundation for a geopolitical and potential rally in equities. This is what we've seen. However, the situation remains fragile because early US intelligence assessments have cast a shadow of doubt on the long-term effectiveness of the pre-ceasefire strikes, suggesting that Iran's nuclear sites were not completely destroyed. This leaves open the possibility of future tensions. Furthermore, mixed messaging from the administration, which initially discussed easing sanctions to de-escalate tensions, only for President Trump to later assess that he was not giving up on the pressure campaign. This adds a layer of uncertainty to the durability of this newfound peace. But for now, the ceasefire holds, and the market is breathing collective sigh of relief. But in this situation, this needs continuous monitoring. The second major pillar supporting this bullish case was for US stocks from the Federal Reserve. Over the past several days, we've heard a distinctly dovish chorus from key officials, led by none other than the Fed Chair Powell. In his testimony twice this week, Powell signaled that a significant majority of policymakers believe it will be appropriate to begin reducing interest rates later this year. He even added a crucial qualifier. If inflation were to cool faster than anticipated, these cuts could come sooner, as soon as July. This dovish sentiment was echoed and amplified by other voting members. Neil Kaskari was particularly explicit, stating that he continues to expect 2 rate cuts in 2025. Also, Mary Daly added to the optimism by noting that the fall looks promising for a rate cut. So this coordinated messaging has significantly boosted expectations for lower borrowing costs, which in turn support higher stock valuations. So what we've seen is, despite the fact that the core PCE price index went negative, we've seen consumer spending and personal income going into the negative. We've seen even the GDP quarter over quarter final in the negative. But at least we saw, excuse me, we saw the Michigan consumer sentiment final in the positive. But this does not matter. Even though the sentiment analysis is 35, because the economic data is not good, this is a fact, we've seen a bullish response, one, from the geopolitical de-escalation, and two, from the Federal Reserve, and none other than Jerome Powell. So let's check the charts to see how is this developing. So basically, this is the weekly chart on the Nasdaq. The Nasdaq is approaching, Nasdaq futures is approaching all-time highs. It's only at 120 points from all-time highs. And in 1 week, we did pretty good. 4.15 in 1 week. If we see the Qs are already at all-time highs. So we are pushing with the help of NVIDIA, with 1 week move of 9.66%, with the help of Meta, with a 1 week move of 7.52%, and with the help of small caps also, with a 3% increase. The ES also pushed 3.42 in a 1 week in futures. And also gold is pulling back 3%. What does all this mean? This means risk on assets. Stocks are pushing higher, small caps are pushing higher, defensive assets are pushing lower like gold. Crude oil is massively pulling back 11%. So basically, even though the economic data is not good, we are seeing bullish sentiment. Let's go to the daily because this has been a massive grind up. I mean, this is clearly a big push, a squeeze, a slow grind in the futures. But let me tell you something. It's always recommended to have a conservative approach to the markets. It's clear that we are hunting all-time highs. But let me tell you, if we go to the 1 hour, we can see how this market can have room for a pullback. We have last week high here, and we have this daily inverse. Let me show you here. We have this gap that we filled in our move up, but in the 1 hour, we have several points of support. Last week high, we have this daily inverse. We have also this open bullish fair value gap on the 1 hour. So all this make me think that perhaps we are going to see a little bit of a pullback for the big players to again push this market, buy long-term positions, and then hunt all-time highs at 22,800s. This is what I would be looking for. We can perfectly go straight to all-time highs and don't look back again. But my best and always recommendation is to wait for better positions. Don't buy the breakout of all-time highs. Please. Trust me, I've seen this in the past. You can lose a lot by playing breakout all-time highs breakouts in futures. Just buy the pullbacks, because right now we are seeing how this market is hunting all-time highs. We all know that this is going to happen, but we have just to be in the best position possible. Let me first show you also some kind of the market internals. The market internals for the volume and the advanced decliners on the ES was a little bit mixed. As you can see here, was in the flows, it's not clear. People is hesitating. On Thursday, we got a big push, and the advanced decliners were pretty much in the highs. We've been pushing and pushing and pushing and pushing. In terms of the cues, we've seen similar moves. On Tuesday, big moves on inflows with the advanced decliners pretty high, a pullback on Wednesday, and then maintain some kind of posture towards the weekend. But I'm not seeing huge, big, surprising, spectacular volume inflows for all-time highs. That's why I'm a little bit concerned about this move. I was saying maybe we have to wait. 2 weeks ago, we have to wait for this 1 hour. We never touched this 1 hour. This white line is the 200 moving average on the daily. It provided support here. Perhaps I was waiting for that again, but this never happened. But that doesn't mean that we are going to continue and continue forever. Let me tell you, there's better positions. This zone here, it's basically 360s and 22,000s. It's just a 300 points area in which, for sure, they are going to be buying here in the long term. They want to be on the track, on the train. So they have to buy. I'm talking about big investors. I'm talking about hedge funds. I'm talking about banks. They have to buy. They have to chase, not to lose the momentum. But you have options. You can have better opportunities and you can have better positions if you wait a little bit for this area. They've been chasing and chasing and chasing. And I think our best opportunity is just to wait a little bit. Financials are looking good. Let me go to the weekly again. Financials are looking good because rate cuts are being expected. Nvidia and technology is looking pretty good. They are pushing. Nvidia, it's been crashing. Amazon is been crashing. Meta, it's been crashing. Let me adjust the all-time highs for Meta. So basically, we are in the verge of breaking these all-time highs on the futures that we touched 2 times December last year. It's been 6 months and we've been basically squeezing all the people that went into these shorts into a double top on all-time highs. So this is going to happen. All-time highs are going to be broken because this is what they do. They keep pushing. But the moves have been very volatile due to the uncertainty in certain aspects. So let me tell you, there will be better opportunities for you to just ride this breakout. But this is not the moment. I'm saying to you the same thing that I told you 2 weeks ago. Just wait for better locations. Don't chase this move. But apart from that, it's clear that everyone's in this summer, everyone's waiting for rate cuts. July might happen. This is what's been pricing in with this move. It's already priced in this de-escalation of the conflict with Israel and Iran. Everything is priced in. But don't get me wrong. We might see a little bit of pullback and then a breakout. But trust me, wait for better locations. And that's all from my side. As always, thank you for your time. If you found this video useful, please give it a like, subscribe to the channel. I upload videos like this one every Saturday for weekly recaps, and from Monday through Friday, daily analysis and a little bit of recaps sometimes when big news happen. So if you are new, welcome. If you are coming back, thank you for supporting the channel. But remember that discipline, patience, and risk management are key for your success. Stay safe, everyone. Have a nice weekend and see you on Monday.